Hi, good evening, ladies and gentlemen. Welcome to our webinar event on the Evergrande crisis and what it means for investors. First of all, thank you for taking your time out of your busy schedule to tune in today. I'm Ziyang from IFAS, and today our team of analysts and I are going to address some of the concerns that you guys may have with regards to the recent Evergrande crisis and its spillover effect it has had on the broader China capital market. So here's a rundown of today's event. We'll have Jackson, our fixed income analyst from Hong Kong, to share more about what's going on with Evergrande at this current juncture and our views on what's the possible resolution of the crisis ahead. Next, we'll move on to Hui Shi, our equity analyst who specializes in China real estate sector, to share more about our outlook for the sector moving forward. Next, we'll have Colin, our macro analyst, to share more about the macro implication of the Evergrande debt crisis and what a possible contagion within the China real estate sector would imply on a broader level. And last but not least, I'll highlight some of the key opportunities that have arisen due to the Evergrande saga and our rationale behind these ideas. So then we'll wrap up this webinar by opening the floor to Q&A, where the speakers and I are going to address some of your burning questions head on. So, but that being said, of course, at any point of time when you guys have any questions, just feel free to submit them using the Q&A function of the webinar. We'll try to reply them as soon as we can, but also note that we'll save some of the better questions, the good questions for the Q&A session at the end of the webinar. So without much further ado, I'll pass the time now to our first speaker of the day, Jackson. And Jackson, here's on to you.
So good evening, everyone. Here's Jackson Chan from Hong Kong Fixed Income team. So today it's my honor to be here to share with you about more on our house view on Evergrande situation and also what we think that is going to happen in the next few months. So for just some quick brief of my sharing. I will first spend a little time to talk about how big is Evergrande and also how does this whole thing happen. And then I will spend more time to discuss about what is the current situation of Evergrande and also what is ahead for us. And last but not least, I will also talk about some contagion effect on the sector and also what is the sector outlook for, especially for the real estate sector. So without further ado, let's start with my thoughts. So I think some of you may, actually all of you may already heard about Evergrande before. And I think some investors also think that Evergrande is it really too big to fail? So why some investors say about this term for Evergrande is mainly because that of Evergrande is the largest developer in China in terms of the attributable contracted sales since 2018. And even right now in the first half of 2021, Evergrande still dominates the chart in terms of the attributable contracted sales. So on the other hand, it is a very large scale developer. It has over around 550 billion RMB in debt and also 950 billion RMB in payables. So also on the social perspective, Evergrande has hired a lot of employees, which has over 160,000 employees and also 900 of property projects around the whole country. And some of the people compare Evergrande to Lehman Brothers, which is the largest bankruptcy cases in the world in the entire history. So, but actually Evergrande does not have the same size compared to Lehman Brothers. So it is around half of its asset size. But when we compare to the second largest bankruptcy in the world, which is Washington Mutual, Evergrande is actually bigger than Washington Mutual in terms of the asset size. So for the whole situation, how this thing happened, and actually I think all of you have to know that Evergrande has been a highly leveraged developer for so many years. So it is actually a red light developer in so many years, because in the previous year, Evergrande has adopted a quick growth strategy, and they try to become highly leveraged and borrow more money in the market. And therefore, and actually until the June of this year, before that, Evergrande is considered a very high leveraged developer in the whole sector. But when we look into the latest statistic and also the figures in the interim report, we saw that Evergrande is actually experiencing deteriorating liquidity. And as well, on the other hand, we also saw that there are some negative news are coming out almost every day for Evergrande since June this year. So first, starting with the Chinese regulator tried to investigate into the Shenzhen Bank situation. So this is the first news that come out in the market, and then there is also relentless negative news coming out, which shaken the market confidence. And therefore, we saw that the yields of the Evergrande bonds have then skyrocketed since June, and which actually cut off all the financing channels of Evergrande, including the bonds issuance and also the bank loan, and also other, for example, the trust loan, and different kind of financing channels are all cut off. And since then, Evergrande has actually missed the payments on different liabilities, including the payrolls and also the land fees and also some wealth management product, etc. So until now, we still see that Evergrande has yet to distribute a coupon payment of the 2022 bond that was due last Thursday. So the bond is actually entered into a 30-day grace period. So after this grace period, if Evergrande still cannot pay the coupon, and then it will be considered a practical default case. So what is the implication right now for investor, which is we think that it's quite clear that Evergrande will utilize this 30-day grace period to see if there is any further development and also instruction from the government. So if we look ahead in October, and actually in September and October, China Evergrande has to pay coupons for 5 USD bond issues, which I only included the bonds with the code EVRE here. So we even excluded the bond, excluded the onshore bond, and also excluded the bond issued by the Scenery Journey, which has the code of TIA and HL. So in the table on the right-hand side, you can see that actually this 5 USD bonds will have to pay out coupon all in September and October with around $300 million US. So why we think that Evergrande will make use of this grace period is that because we think that they will handle this coupon payments together as a whole instead of individual repayments of some specific bonds. So actually last week there was news saying that the Chinese government are trying to tell Evergrande to avoid some near-term bond default. And our take right now is that we still think the group is trying to prevent the default on its public bonds if they still have the cash on hand. The reason why is that Evergrande, if Evergrande really defaults on its public bond, and then it will trigger a series of cross defaults and also some legal claims to liquidate all its offshore assets. So the offshore assets we are talking about here is includes the major listed subsidiaries and companies that China Evergrande has equity ownership, which include the Evergrande Property Service Group and also the New Vehicle Group and also the Hang Seng Network and Shenzhen Bank, etc. And therefore, we saw that actually Hangda Real Estate is the Evergrande onshore property division. So they last Wednesday, they announced that they have resolved the coupon payment through some negotiation with the bondholders of the clearinghouse. So in the picture here, you can see that in Chinese, the point is that this this payment method is a little bit special, which is off the clearing house, which is not a traditional way to pay out the coupon. So we believe that it is actually not a full cash settlement. But on the other hand, for the USD bond, the Evergrande cannot do the same because, relatively speaking, the onshore bond holders are mainly some institutional investors located in China. So the negotiation process will be much easier for Evergrande. They can just find the bondholder and then talk with them and negotiate with them, and they can settle the coupon payment using the clearing house method. But for the offshore bondholders, it will be very difficult to apply a similar approach because this kind of bondholders, they are mainly overseas fund house and also some private banks and also some retail investors. So that's why until now, we still do not see Evergrande trying to use any approach or method to resolve this problem on the USD bond coupon. And currently, we know that the group is prioritizing the completion of the residential projects. So we think that if they really want to reserve the cash for delivering the house to home buyers, it is actually not a good news to bondholders. And meanwhile, if Evergrande, currently we saw that the Evergrande asset disposal plan is not going quite smooth. And we did not see any major transaction over the last few months. So until today, actually this morning, Evergrande released a statement and saying that they sold 20% of the stake in Shenzhen Bank for in exchange for around 10 billion RMB. So this is actually the first major transaction over the last few months that we saw from Evergrande. So if the bonds really go into default, offshore bondholders will have the right to claim against the onshore and also the offshore assets held by the China Evergrande Group. However, the onshore assets, in terms of our view, we think that it is harder to recover because it is mainly consists of some debt distressed companies, including the Hangzhou real estate. So we think that the onshore assets is not really comparatively, it is not as important as the offshore assets. So for the offshore assets, which is mainly including the equity ownership of several listed companies, as the table below, you can see that Evergrande is holding 5 listed companies in its portfolio, and we think that this asset will actually provide some cushion for the recovery value of the bond. And right now, we saw that the Evergrande bond price and trading at a level lower than already some of the defaulted bonds, including the China Fortune Land and also the Sichuan Languang and also the Suning Appliance. So in the table that here, you can see that Evergrande bond. Let's take the 2025 bond or 2022 bond. They are all trading at around $25 and $26 per $100 in face value. So other defaulted bonds, including the China Fortune Land, Suning Appliance, and Languang Development, you can see that all of them, the bond price is actually higher than China Evergrande. But we think that this situation is not usual because Evergrande, in our point of view, we think that it has a higher quality asset portfolio. So we think that the haircut level under a debt restructuring will not be lower than the current price. And therefore, for the bondholder, the incentive to sell the bond right now is quite low. But that being said, we don't think full liquidation situation will happen. We actually think that the most possible outcome right now is a debt restructuring. So referencing to some previous cases, it usually takes around 1 to 2 years for a repayment plan to be developed during the restructuring process. So although we all know that Evergrande is quite different because it is all under the spotlight, and we expect that there will be a lot of different creditors, and these creditors will be more aggressive in taking action to claim or to liquidate Evergrande assets. But still, we think that investors should have the preparation that it would take quite a long time to solve the whole problem, and they have to take time value into the consideration. Next up, I'm going to talk about the contagion effect on the real estate sector. And actually, the market is quite concerned about that the financial institution will not borrow to the developers anymore. So, and as you can see in the chart below, it is the chart compiled by our team. And we can see that the Chinese real estate USD bond yield is skyrocketing in the recent months. And for the green line, you can see it is the average yield to maturity of the single B rated bonds. So you can see that right now, the average yield is at around 24%, the yield to maturity. And we even exclude the Evergrande because Evergrande is already being downgraded. And also we even excluded Scenic Holdings, which is another distressed developer. So if the developer is being downgraded under the single B tier, we will exclude them. And even with this exclusion, we can still see that the average yields reach around 24%. So it is a very very rare situation right now, and actually at the current yield level, it becomes an almost impossible task for these highly leveraged developers to refinance the debt using some traditional borrowing methods. So on the other hand, you can also see that double B rated bonds are yielding at around over 10%. So we believe that the sell-off is actually pricing in a nationwide systematic financial risk. But what is our view on the property sector now, and what will be happening in the next few months or even the next few years? And actually, we think that the property sector is now coming to a turning point because the recent sharp fall in the sales was mainly caused by different factors, including the policy control and also the increasing difficulty of the mortgage applications, and also a lot of different reasons. And you can see in the chart below, actually. In July and August, the sales has dropped quite a lot compared to the first half of the year. And also in August alone, the year-on-year decline is around 20% in terms of the total sales. So we saw that this sharp fall is actually quite a turning point in the sector, and we expect that the weak sales performance will last until the end of this year, except the Chinese government try to loosen the regulation control. So the market sentiment right now is really weak, so especially after this Evergrande incident. So not only we saw that the home buyers lack the willingness to buy, and also the developers also becoming quite conservative when it comes to the land investment. So despite that, the fact is that the sector fundamentals are weakened significantly. Actually, we think that it does not turn into a completely non-investable environment because we saw that the strong demands over the last few years will just not suddenly vanish and disappear and then never come back. And we also believe that the Chinese government does not want to see a full collapse of the whole sector and tons of developers going bankrupt. So with the stabilizing is one of the top priority. We think that it is very likely that the government may loosen the regulation in future, especially in the second half of this year. At this point, we think that the most our point of view is that we think that more appealing investment opportunity have emerged, especially as you remember the chart I have shared in previous slides, that the double B rated issuers, the average yield is over 10%. However, this kind of issuers, some of them are dragged by the entire sector sell-off instead of having any deterioration in their own credit. So we think that this kind of opportunity is quite rare. So investors may look into this kind of double B rated issuers, which should have a healthier credit compared to the single B rated issuers. But at this point, we think that selecting the suitable issuer become more important than ever. So how can we select the some suitable issuers to invest? And actually, some of the simple way, including we can use the 3 red lines approach, which is actually a standard in the sector to test the leverage level of any individual issuer. So in the table below, we have already compiled the latest free red light distribution of the mainstream Hong Kong listed developers. So as you can see, actually most of the developers are located in the yellow light and the green light. But however, we still have to bear in mind that because recently some distressed developers, they also fall into the yellow light or green light category. So this is just a very quick and simple way to assess the developer. But however, for more analysis and details, I think you must have to maybe read our article and analysis on our platform that we will have a more detailed look through into the credit status. So yeah, and I think that's the end of my part today. And I'll hand over the time to Hershey, and she will be talking about the equity outlook of the Chinese real estate sector.
Okay, thank you, Jackson. So hi, everyone. Good evening. Thank you for joining today's webinar. I'm Hui Shi. I'm an equity analyst from the Stocks and ETFs research team here at iFAST. So the deepening Evergrande debt crisis has also negatively affected the equity markets, and the Chinese real estate equities, it was one of the worst hit sectors. So Chinese real estate equities, as gauged by the MSCI China Real Estate Index, is now down by over negative 20% within the past 1 year. So how should investors make sense of what is going on right now? And more importantly, what is next for the Chinese real estate equities? So let us first look at China's housing market. The housing boom has continued to slow down. And last month in August, average prices in the 70 major cities in China, they recorded a year-on-year growth of 4%, which was actually the lowest in 6 months. And month-on-month prices, they only grew at 0.2%. So we believe that this means that the regulations implemented over the past year are working. And to name a few, there were limits on debt growth, also known as the 3 rate lines, caps on the banks lending to the real estate sector, as well as the hiking of mortgage rates in several cities. Now, going deeper, we also observed that the growth in housing prices, it is differentiated based on the city tier. So the tier 1 cities, they have recorded the strongest growth, and this is being followed by the tier 2 cities and then the tier 3 cities. And the main reason why tier 1 and most of the tier 2 cities see stronger growth in housing prices is because of the relaxation of the hukou restrictions. So the relaxation of hukou restrictions, it speeds up the rural-urban migration in China, leading to a population influx in the largest cities, which creates a demand for urban housing. And this also comes as China strives to transform migrant workers into urban residents, resulting in more efficient allocation of resources that will help to spur the economy. And so therefore, supported by the strong fundamentals, we expect higher tier cities to maintain some level of growth, even as the tighter regulations stay in place. And meanwhile, we anticipate a further weakness in the lower tier cities, such as the tier 3 cities, due to a lack of tailwinds on the demand side. And based on our findings, that the majority of developers who are in the MSCI China Real Estate Index, more than 80% of them, they are focused on the tier 1 as well as the tier 2 cities. But of course, there are also selected developers which are focused on the lower tier cities, such as Evergrande as well as Country Garden. Now, looking at the profitability of the property developers in the open land market, there has been an aggressive bidding of land. So this has pushed up land prices, leading to a decline in gross margins of developers over the last few years. So as shown by the chart here, gross margin has fallen by close to 9% since 2019. And earlier this year, with the aim to help stabilize land prices, China has required 22 big cities to coordinate land auctions. So this is a step up from previous procedures where local governments, they release land parcels unevenly without a schedule, causing developers to aggressively bid for land. And right now, the first batch of centralized land supply has already been conducted from April to June. However, it did not meet expectations as the average land premium rate in the 22 cities remains elevated. So you can see from this table here, the average land premium rate from the first batch of centralized land supply was at 15.4%, which was around 3.3% higher as compared to last year. But nevertheless, we observed that certain cities like Fuzhou, Beijing, and Shanghai, which are at the top of the table here, they saw a substantial decline in their land premium rates. And in view of the overall elevated land premium, many cities, including Shenzhen and Chongqing, they have also recently announced that they will lower the land premium cap to 15%. And so with the lowering of land premium caps, we do anticipate land prices to be kept under control. So this not only helps to stabilize housing prices, but also the gross margins of developers. And right now, the second batch of centralized land supply, it is currently ongoing. But based on some of the cities that have already completed their auctions, it is quite noticeable that the land premiums have indeed dropped. It's also important to understand that not all developers are created equal. While some developers, they are highly leveraged, like Evergrande, there are also some developers that have very healthy balance sheets. And the three red lines, it is a reflection of the central government's intention to control the housing market and prevent the risk of a housing bubble. And as shown in the table here, we found that about 11% of developers who are in the MSCI China Real Estate Index, they have violated at least two red lines. So these are the developers which are overly leveraged. And meanwhile, about 32% of developers in the index, they have violated only one line, and they are allowed to grow their debt by about 10% per annum. So from an equity perspective, developers that have yet to fully meet requirements under the three red lines, they will bear the brunt of China's stringent policy. And as debt reduction has become the top priority, they have been slowing down on land acquisitions, and some of the overly leveraged developers even had to sell off their non-core assets or even sell their homes at a huge discount. But the good news is that about 57% of developers in the index, they did not violate any of the red lines. Their balance sheets can be considered as the strongest, and so they are allowed the highest level of debt growth, which is at 15% per annum. And their stronger balance sheets provide the room for them to expand their land bank prudently, helping them to achieve healthy and also sustainable earnings growth. Also, some developers are even diversifying their income stream through construction services and property management. And this could help to balance some risk from the property development business and also help to drive earnings growth. So take, for example, China Resources Land, which is a large developer that had met all the three red lines. It derives around 18% of its revenue from construction services and property management, which is considered as one of the highest in the entire sector. And lastly, moving on to the key risks of investing in the Chinese real estate sector right now, it is none other than the contagion from Evergrande. The MSCI China Real Estate Index, it is trading at a historical low right now in terms of its PB ratio. And while valuations do indeed look cheap, we don't know whether the contagion risk from Evergrande has been priced in fairly yet. Firstly, in the worst case scenario, the collapse of Evergrande, it will raise refinancing risks in the entire sector. So this will drag down other developers. And we expect the impact to be more significant for developers which are highly leveraged. Because if the offshore credit market is closed off, then the highly leveraged developers will not be able to refinance all of their borrowings. And in the base case scenario, we expect Evergrande to undergo restructuring. And healthy developers, they could potentially be asked to take over Evergrande's unfinished projects in exchange for a share of Evergrande's land bank. And another possibility is that the developers which are backed by the government, they could be asked to buy over some of Evergrande's assets. The potential impact of this, it is still unclear, but we do note that Evergrande's land bank, it is focused on the tier 2 as well as the tier 3 cities. And generally, housing demand, especially in the tier 3 cities, has been very weak. And lastly, in the best case scenario, Evergrande, it may get a bailout from the Chinese government. However, in our view, this scenario, it is the least likely to happen, as the bailout of Evergrande would send the wrong message to other highly leveraged developers. So overall, as China ramps up efforts to narrow inequality under their goal of common prosperity, the real estate sector may potentially face more regulations, and there will still be some way to go before regulations can be loosened. And growth in the sector is also likely to slow down in the current backdrop of deleveraging. And so in view of the near-term headwinds, we've actually also downgraded our fair PB ratio for the Chinese real estate sector to 0.9 times from our initial 1 times. And this will roughly translate into an upside potential of 75%. But despite the attractive upside potential, we are seeing a lack of a near-term share price catalyst because of a lack of a clarity on the Evergrande situation, as well as uncertainties on the regulatory front. And we are also cautious that the valuations have even more room to fall due to the contagion from Evergrande. But nevertheless, we believe that the negative impact, it will vary across different developers. And developers which have healthy balance sheets, as indicated by the 3 red lines, they are likely to be more resilient when facing the near-term headwinds. And so for investors who want to invest in the Chinese real estate sector right now, we think it is best for you to be prudent and to be selective in your investments within the sector. And so with that, I've come to the end of my part, and now I'll hand the time over to the next speaker, which is Colin.
All right, good evening, guys. So now that we heard Jackson's detailed presentation on Evergrande, as well as Hui Shi's presentation on Evergrande's impact on the global equity markets, or rather more specifically the property sector. So now I will take you guys through what is the potential implication on global credit markets, and more importantly for investors, what is the potential impact of the Evergrande fallout on your bonds and portfolio. So without further ado, let us dive right in. So once again, echoing what Jackson has said, the message is why Evergrande matters for global credit markets, and simply because Evergrande has a significant presence in the larger sector within the China high-yield offshore markets. So if you can take a look at the chart on the left-hand side, which shows the percentage of Evergrande as shows Evergrande as a percentage of the China high-yield offshore bond markets. You'll find that Evergrande is one of the largest real estate companies there, and it comprise approximately about 10% within the high-yield offshore bond market, which is 10% might not seem much on an absolute basis, but in fact, if you look across the other components, 10% is actually a lot. And if you look at the property sector in general and how much it is within the offshore high-yield market, you'll find that property sector consists of or comprise up to a whopping 70% of the entire offshore bond market. And again, this shows the impact and why Evergrande situation, the fallout of Evergrande matters to global credit markets. So diving right in to what I believe, and in my opinion, is one of the most important indicators out there right now, which is the China IG offshore bond markets. So we look at a couple of different bond markets around the world and look at what is the potential impact of this Evergrande situation. And firstly, if we to look at the credit spreads between the high-yield bond as well as China's IG bond, you'll find that spreads, as shown on the chart on the left-hand side, spreads for Asia high-yield bonds have surged during this period, while the IG bonds were unaffected. And if you zoom in at the year-to-date period, you'll find that after the brief spike, the China IG bonds actually retrace back down, and this shows the pricing of risk that is very different between the IG as well as high yield. So, in fact, the high yield is saying, hey, there is no stress within this high yield segment. We are not affected as compared to the China high yield bonds. We are, which is actually screaming higher and higher. So let's look at some of the factors that is contributing to that. So if you look really look beneath the hood at some of the underlying some of the fundamentals with the high yield as well as IG issuers, you can find as shown on the chart here, that the ratings issued by Fitch for China high yield issuers have actually increased in this year. And you'll find that the upgrade to downgrade ratio have actually fell, in fact, quite tremendously over the past couple of quarters, in fact, the last 2 to 3 quarters. And the situation, in fact, much reversed for the IG issuers. You'll find that the IG issuers have seen more upgrades recently, especially the last quarter, and the downgrades have in fact declined. So looking at these two different pictures, it shows that at least on a fundamental basis, the IGs are less affected than the high yield. And this a key reason why we look at IG is because a lot of the big companies, especially the financial companies, are within the IG space. And if the IG space is relatively unaffected or has shaken off this impact, it is telling us that, in fact, the impact of Evergrande's fallout is, in fact, very much localized within the high yield space. And within the high yield space, the next question, of course, is to look at which sector is actually driving this. And of course, the direct answer is the real estate sector. But to actually affirm that hypothesis, we look at the yield of the largest players within the China high yield offshore bond index. So look at the top 5 players, for example. So if you look at the top player, which is the Bank of Communication, there's almost nothing to see there for yields. Yields have ticked up, but there's nothing significant. So and we look at the second largest player, which is Kaisa Group Holdings. So we look at that, you can see quite clearly that yields have exploded higher, and this in fact is a real estate company. And if you look at the third biggest player, which is Lenovo, also nothing to see there. And it's not a real estate company. And we look at the fourth player, which is Evergrande. Of course, the yields also reflect the same thing. It have exploded a lot higher. And similarly, to the fifth largest player, which is Sunac, yields have exploded higher as well. So the takeaway from all these different charts here is that we see a distinction in yields across the sectors for China high yield offshore bond markets. So there is this distinction between real estate versus non-real estate sector. So some stress, of course, can be seen across the broad China high yield market, but it is overall not as severe as what you've seen for the real estate sector. So the non-real estate sectors are, in fact, pretty much still all right, in my opinion. And also the fact that we see that this stress is mostly concentrated within the real estate sector company. So to rewind a bit, earlier on I mentioned that the stress itself is located within China high yield markets, and now we have shown that within China high yield markets, it is mostly emanating from the real estate sector. And again, if you look at some of these fundamentals lying underneath the hood, we see that actually in the year to date, the percentage of default in the China offshore bond markets, a lot of it, especially over the past couple of quarters, is comprised of your real estate sectors. So the same goes for your onshore bond as well. So in fact, both onshore and offshore bonds in the year to date, 34% of the default are coming from the real estate sector. So very much beneath the hood, the fundamentals actually supports what the yields are saying and what the message of the yields are telling us right now. So next, we also try to find out, is there any spillover to your sovereign bonds? Because if there is a spillover to sovereign bonds, that could be a sign of systematic risk. So to do so, we looked at the China sovereign credit default swap here. So the 5-year credit default swap, the spread here. So as shown from the chart, we see an uptick in the 5-year CDS, and that tells us that investors are protecting against some of the credit risk that they are expected to happen within the China sovereign bonds market. But if you look at it on a historical basis, we'll find that while the CDS has risen lately, the current level remains relatively low versus history. So in fact, if you look at the past 5 to 6 years, we find that where the current CDS is right now is in fact around the mean level of the last 5 to 6 years. So it's nothing really outstanding, and again, it is not showing any clear signs of systematic risk. And to take it a step further, if you look at it from a year-to-date perspective, you can see that the CDS spread is beginning to retrace back down after hitting a year-to-date high. So it went up about around a 10 plus basis point, about 12 basis point, and now starting to retrace back. And that is telling us that some of the fears that investors have with regards to a potential of a systematic risk is starting to abate. Right, so let me put all things together. So we can see quite clearly over the last couple of slides that the impact, like I mentioned earlier, is likely a domestic one that is contained within the China high-yield bond markets, and particularly within the real estate sector. So there are three things that we note over here. So firstly, there is no signs of a funding stress within the broader China bond markets, such as the IG bonds. And to supplement that, we also looked at the liquid China corporate index, which is shown on the right-hand side, and that measures the most liquid IG bonds within the onshore space. And from what we are seeing right now is the credit spreads have moved up about 8 basis points, but it's still far from its year-to-date high, and definitely far from what we seen in June when when some of the serious Evergrande issues were being first brought up. So overall, there's no funding stress, there's no liquidity issues within the broader China bond markets. And also, like I argued earlier, there's little direct impact on sovereign bonds. And thirdly, the stress is also mostly contained within the real estate sectors, and not yet severe enough for the non-real estate sectors. And overall, we do believe that stress within the China high-yield markets should persist, as like what Hui Shi mentioned earlier, or even Jackson mentioned earlier, the real estate sector is likely going to face some headwinds, and we are going to see a slower growth. So stress definitely will be there for in the near term, but overall, it is relatively contained and limited domestically. So over the next couple of slides, I will explore what are some of the potential impacts on the global credit markets. So let me first begin with the US bond markets. So if you, as you can see from the chart on the left-hand side, which shows the credit spread of US high yield as well as US investment grade bonds. So again, the message is quite clear here. Spreads of US high yield and IG bonds barely budge, even during the latest happenings of the Evergrande issue. So if we can zoom in detail with regards to the year-to-date period, we'll find that after this, there is definitely a brief increase in credit spreads, but soon after, spreads have retraced back to year-to-date lows. And you compare that to what we've seen in July, for example, it is on a relatively small scale, and certainly on a smaller scale if you look across history. So US high yield and IG markets are saying that, okay, they are not reacting at all, and there's definitely no stress from the US bond markets from what the credit spread is telling us. So the same can be said for European bond markets as well. So if you look at the spreads for European high yield as well as European IG, they have not budged at all, and there is almost no reaction to the latest Evergrande news. And if you could look at the year-to-date period as well, you can see that IG bonds, European IG remains relatively resilient, whereas European high yield remain resilient as well. And if you look at the CDX for European corporate bonds, so the credit default swap for European corporate bonds, you'll find that there is definitely a small uptick, but again, the message is clear, or message is similar to what I've said earlier. We see investors having that smaller panic when it comes to the default risk for European bonds being contaminated by your Evergrande. But after a couple of days, that risk has come down. So we see that CDS falling a few days later for the European corporate bonds. So the next couple of slides, I'll show you where the impact is being felt. So firstly, the impact is felt in emerging market debt, especially the US dollar issuance. We'll find that if you can look at the chart on the left-hand side, you'll find that the EMD USD credit spreads have risen a slight bit. So if you look at the year-to-date basis, it has risen almost up to a year-to-date high. But overall, the same story is painting out. It is not a lot when it comes to when you compare it across the historical level, and we find that the pace of the rise as well as the magnitude of the rise is in fact considered quite minor versus some of the issues, some of the main periods where credit spread has spiked, such as your 2012, your 2016 when EM slowed down, and also recently during the COVID the period. So all in all, there's not much to see, or there's not much stress within the EMD market. And moving on to the EM high yield markets, you'll find a higher uptick relative to history for for EM high yield, but overall the message is similar. So when you look across history, this current level of spread itself is still relatively minor. And while the year-to-date spreads might have risen to a year-to-date high, but I think overall there's still not much risk being implied when it comes to the spread level. So moving on to where most impact is felt, which is Asian bonds, particularly Asian high yield bonds. So if you look at the chart on the left-hand side, you will see it shows the credit spread for the Asian high yield versus the Asian IG bonds. You'll find that similar to what I shown earlier for China high yield, the spread for Asian high yield have surged while the IG bonds were relatively unaffected. And if you look at it from a year-to-date basis, the divergence in fact have widened after the recent Evergrande news. So market is expecting some level of stress within the Asian high yield bond segment, whereas the Asian IG bond segment has struck off the stress, struck off the impact of the Evergrande fallout. So if you look at that, if you look at the spike over there since June period, and a lot of it is largely being driven by the spike within the China high yield period, and both spike have actually coincided together. So that itself is very telling that market is pricing that in the Asian high yield bond market because of its exposure to China high yield bonds. And that leads me to the next point, where we see that the impact from the spillover itself is pretty much limited by the exposure to China bonds. So broadly, there's two key messages here. Firstly, we see no signs of stress in the global credit markets, both high yield as well as IG. And secondly, the impact itself is limited by the exposure, like I mentioned earlier. And if we look at the VM credit itself, we think it is least at risk to a spillover because it has no exposure to your China bonds market. So if you look at the chart on the right-hand side, you'll find that both US as well as European IG and high yield bonds have no exposure to China bonds. And if you look at the EM credit, there is definitely a minor risk to a spillover because aside from the exposure to China bonds, there is definitely the currency exposure when it comes to weaker EM currency as well because of this issue. And therefore, there's two different channels of exposure right here for EM credit. But overall, we think it should be broadly safe, largely because the direct exposure to China bond itself is quite limited. Firstly, for EMD, it is only exposed to your agency or your quasi-sovereign bonds, as well as sovereign bonds, which are relatively safe, like I mentioned earlier. And also, when it comes to high yield itself, is also exposed to your agency bonds as well as corporate bonds. And corporate bonds are the one that is of a slightly higher risk, but within that, the high risk one is still within the real estate segment. So that itself is relatively lesser. And moving on to Asia IG, we believe there is a little risk there. Firstly, because like I argued earlier, China IG bonds are relatively safe, and broadly Asian IG bonds are still relatively safe as well. And if you look at definitely the highlight here will be Asian high yield. Like I mentioned earlier, there is definitely a higher risk to a spillover effect, largely because of its exposure. So for Asian high yield, there is about 40 to 50% exposure to your China high yield corporate bonds, and within that 40 to 50%, around 30 to 40% is the real estate sector. But to that end, we are not overly concerned because firstly, direct exposure to Evergrande is relatively minor. So it depends. For major benchmark, the direct impact is less than 1.6%, and the largest exposure within the top 10 ranking is probably around 0.6, 0.7%. So the direct exposure is relatively minor, and also the fact that the risk itself is currently limited, as like I mentioned earlier, the impact itself is contained within the China real estate sector, and that sector itself is not the entire high yield corporate bonds, and it is only about 30 to 40% of that. And overall, if you look at China's real estate sector being affected, it takes a lot for that to happen, and we think that is definitely one of our bearish scenario. And for that to happen, we think right now there is a lower likelihood, and therefore overall, with regards to the exposure for Asia high yield towards this Evergrande fallout, we think is still relatively minor. And of course, if you look at more broadly in terms of the other barriers to a potential wider scale spillover, we see two, in fact. So firstly, one is by the central bank support, by major central bank support. So that itself works its way in the external channel, which is something more global. And we also see support by the China authorities intervening, and that itself is something more internal and something happening within China. So firstly, for central bank support, around the world, there's still largely easy monetary policy, especially for DM credits. And that itself doesn't limit to DM credits, because easy monetary policy by major central banks have tendency to spill over to EM credit as well. So we see that happening in the global background. And also liquidity remains ample in most of the major bond markets. And overall, the interest rates are still relatively low, although we expect rates to be elevated in the 1 or 2 years time, but right now itself, rates are still low, liquidity is still ample, and we think the situation, at least for some of your global credit, is still supportive when it comes to central bank support. And aside from that, if you look internally within China, within the China authorities itself, they aim to protect economic and financial stability. And like what Jackson mentioned, they have an interest to prevent a systematic risk. And aside from that, if you look at the recent action of PBOC, the Central Bank of China, we see a move towards a more liquidity injection, and move towards a more easing, and that itself is sending a message that the Central Bank of China wants to keep the fallout, or keep the contagion effect limited by injecting the liquidity into the market. So aside from the couple of factors that I mentioned earlier, there is these two factors that is also preventing a wider scale spillover. And not to say that there is no spillover, but those two factors actually curtails the impact of, or curtails the probability of the spillover. So moving on to my last slide right here. So here are just some key takeaways I would like you guys to have from my presentation. So firstly, like I argued earlier, Evergrande's impact is currently contained domestically and mostly within the China high yield markets, and in particular the real estate sector. Also, we also assess and conclude that there is no major spillover to China IG bond markets. And also there is no major spillover to global credit markets at the moment. And the impact itself is pretty much limited by the exposure to China bonds. And last but certainly not least, since this situation is still fluid, we do believe that a wider scale contagion is probable, but the likelihood is slim at the current moment. So there are several signs that we are watching out for right now. Firstly, there is the credit stress within the broader China high yield markets. Also, we are watching the China IG bond market closely for the reasons I mentioned, and also for further signs of systematic risk within the financial sector, which in our case right now it seems quite unlikely. So with that, I've come to my end of my presentation, and let me pass on to Ziyang, which is the next speaker. Ziyang, please.
Right. Thank you, Colin. So yeah, for the last segment of, just give me a moment, let me share my screen. All right, so yes, so it comes to the last segment of our presentation, where I'll kind of briefly highlight some of the opportunities that has appeared within the China capital market amidst the sell-off that was led by Evergrande saga. So what we have seen over the last 2 weeks, since the mid of September, when the Evergrande debt crisis kind of unfolded, to some extent, global assets as well. It's because of the amidst the panic and pessimism surrounding the China market, is left to right. Aside from the China Evergrande group, we felt the hardest, given the fact that it was sort of in the epicenter of the crisis. We see that China financials and banks also saw quite a big hit, about 78% just over the last 2 weeks, followed by the real estate sector at around 6.6%. And I think interestingly, you see that within China tech sector, it actually saw a further sell-off, despite almost having no direct relation and it's mostly implicated because of the the general pessimism around China equities, alongside the kind of prolonged regulatory overhang that kind of worsened the things. But all the way, from your MSCI China to China A shares to the Asian high yields, as well as investment grade bonds, all of these segments were implicated because of the Evergrande situation, and some of them were simply because of panic sell. And I think, in a way, if you look into, say, using the AH premium as an indicator, so I think the idea that the recent market sell-off is driven partially because of the poor investor sentiment is also supported by that this widening AH premium, which measures the difference in valuation on onshore domestic A shares versus the offshore H shares that were that are usually invested through via the foreign investors. So you see that onshore equities are now trading near almost 50% more in terms of valuations versus those offshore ones. And it's near the highest level in almost 5 years. When the underlying companies are exactly the same. So these are A shares and H shares of the same company, one being traded within domestic China and one being outside in the offshore China through the Hong Kong gateway. And this kind of shows that the sentiment of foreign investors in terms of China equities is just extremely poor right now. I think because of a lot of things that has happened within China itself, from the regulatory across different sectors to now after the Huarong crisis and now Evergrande crisis. I think a lot of foreign investors kind of threw in the towel and then they just sold off. And I think because of this exact situation, I think the opportunities have kind of opens up for value seekers to to be able to get exposure towards China, or to kind of accumulate exposure towards China at the cheaper valuations. And the fact that the domestic onshore A shares investors are a lot more optimistic of the future prospects kind of show that things are actually still going pretty well, given the fact they are so they are so nearer to the proximity of the whole entire situation right now. So what we are seeing within the fixed income market is that there's opportunity within the Asian high yield as well as the Asian investment grade bonds, the segment that Colin is talking about previously. And I think by capitalizing on the sell-off caused by negative sentiment, I think investors are able to get a bit of a better bargain at this point of time. So the first I think elephant in the room is the Asian high yield. I mean, given the fact Evergrande debt crisis is definitely one of the key factor within the Asian high yield bond market, and I think the whole China real estate bonds is a huge part of the Asian high yield universe. And given the kind of outsize, about close to 30% of the Asian high yield universe is just China real estate developers. So the kind of crisis coming out from Evergrande, as well as the possible contingent effect across the property developer within China, has definitely affected that market. But yet, I think we argue that the attractiveness of the segment, more specifically the investment thesis as to why we invested in Asian high yield, or we shout about Asian high yield right from the start, remains largely intact. So first off, it has the highest yields in the global bond market at this today, and even more so, I think previously, just 1 to 2 months ago, it's only offering about 8%. Now it's about 8 to 9%. Now it's about 10.3%. It has attractive valuations in terms of credit spreads, both compared to historical as well as relative to its other peers, such as the US high yield as well as your European high yield. And it has one of the lowest duration, which also makes it resilient to any interest rate changes, particularly as you see over yesterday and the past 2 trading nights, is that the kind of risk coming out from rising treasury yields, which kind of makes a lot of other bond segments very vulnerable. But this is not going to be that much of an issue for Asian high yield, given the fact that duration is simply pretty low for this particular segment. So I think while default risk is definitely picking up within the China at this point of time, the yields offered by the Asian high yield segment is picking up as well, meaning that bondholders of Asian high yield right now is actually rightfully compensated with the higher credit risk premium. It's offering at yield to worst of 10.3%. So while defaults could rise further, current valuation kind of more than compensates that rising risk. And this is where we are seeing within the chart on the left kind of shows that the credit spreads versus peers within the high yield segment. So your global high yield, your high yield space have widened significantly, meaning that the rising default risks are already kind of priced in at the moment already. Not only that, I think the chart on the right kind of shows the historical credit spreads for Asian high yield has shot up to over 2 standard deviations of its average level. And we're historically what we have seen is that it doesn't stay there for long, meaning that valuations are getting actually quite appealing. And when the whole situation start to stabilize a bit, I think things will start to come down a little bit, and it will be difficult for you to get exposure to Asian high yield at such attractive valuation once this whole thing clears up. And I think not talking about the fundamentals, going further just on the valuation, and is that when it comes to the China real estate developer, aside from Evergrande, is that as a whole, they have actually made quite a stable improvement in terms of the credit health of the entire industry. I think the whole 3 red line matrix kind of was implemented last year. And we have seen that a lot of because after the implementation of the 3 red line, credit metrics have overall improved quite significantly. We see fewer listed China developers kind of breaching the kind of regulatory limits just in the span of 1 year. The chart on the right shows the percentage of REITs has decreased from 22% in the first half of 2020 to just 7% 1 year. And this Evergrande episode only served to warn these players, especially players who who wants to restructure to quicken their act and accelerate their debt reduction plans. So while Evergrande could default, we think that the authorities could also do a lot of steps to prevent this debt crisis from destabilizing the entire financial system and its economy. And that being said, and if you want, for investors who are still fearful of all the individual name, this whole segment you can kind of spread out the individual issuer risk by investing into an Asian high yield fund. That way you spread out the idiosyncratic risk, which essentially a basket of issuers across different sectors, across different geographical regions within Asia itself, which also means that you get exposure to the higher yield, but yet at the same time the risk is a lot lesser than it would have been if you invest into one specific China bond. So when it comes to the second idea, is really the Asian high yield bonds, Asian investment grade bonds. So like what Colin has mentioned just now, is that the Asian investment grade bonds are not that affected from the risk or the credit stress coming up on the China real estate developer. So I think investors looking to reduce their risk exposure towards the Asian high yield bonds could actually de-risk by just switching towards the Asian investment grade ones. So while the yields are lower, they are a lot safer. And at this point of time, I think even China's efforts deleverage and possibly turning, the potential turning into a potential credit crunch within China, can rest assured that this is not going to be a problem for the Asian high yield investment grade segment. The deleveraging effort that may starve credit within the high yield space is unlikely to affect the investment grade space, given the fact that fundamentals are still pretty solid amongst the investment grade bonds. So and if you just look simply within the investment bond space across the world, Asian high yield investment grade bonds continue to provide one of the highest yields, about 2.23%, which is kind of double that of the global investment grade bonds. And not only that, I think Asia high yield also offers the lowest duration amongst these investment grade peers, meaning that it's least vulnerable to a rising interest rate backdrop, especially when we see Fed is starting to taper and taper their asset purchases that could kind of accelerate that increase in treasury yields 10 years treasury yields. So this is not going to be less of an issue for Asian investment grades versus all the other investment grades in the world at this point of time. So we'll move on. But of course, I think the opportunity is not just within the fixed income space, although of course the fixed income space was the epicenter of it. But aside from the two segments, the equities market were also kind of affected because of the Evergrande situation. And particularly the sell-off in the bond market kind of spilled over to the equity market. So over the last 2 weeks, we saw China financials, we saw China technology, onshores, even onshore equities kind of corrected from between 2.8% to about 8.1% just over the last 2 weeks. And over the next few slides, I'm going to explain my rationale why we think that these ideas are actually still quite attractive, and in fact more attractive given that a recent correction. So the first one would be the China financial sector. So this sector, I mean, because of all the negative press from Bloomberg, CNBC, investors were kind of comparing the Evergrande debt crisis to that of the Lehman crisis back in 2008. And because investors were worried of a Lehman type kind of credit crunch, financial contagion within the bank sector, the financial sector were also hit pretty hard by the sell-off due to the worries of the spillover effect due to bad loans on banks. But that being said, right, the truth is it's not going to, I think that is a little bit overblown. We think that the fears, we think that the material impact on the bank's P&L due to the write-off in Evergrande is actually quite limited. So a risk of a Lehman type kind of financial contagion is simply, it's really quite limited, even if all of Evergrande debt were to be written down to zero. And also at the same time, you know, China banks have quite limited exposure to Evergrande and have kind of reduced their exposure towards property developer loans to just 7% across the bigger China banks. And I think if you look in terms of the CET1 ratio, which is the capital adequacy ratio, is that a lot of the big four banks are very well capitalized, and they should be able to withstand a lot of even if the whole Evergrande were to default, they will be able to well buffer themselves against this kind of debt default crisis in the real estate sector. And also partially because of the sell-off, valuations of China banks are now simply near the lowest of their historical range. Right now, they're trading at about 0.42% for the big four banks, which is the lowest in the whole entire decade. Meaning that, you know, downside risk is actually pretty limited coming from the China banks itself. And I think the good news is that because of the current economic crisis, weakness within China itself, it also kind of calls for the government to kind of ease a bit of their monetary policy. What we are seeing is at the start of the year, the PBOC actually kind of tightened they kind of normalized their expansionary policy, given that economic growth were quite stable. But now that, you know, things are starting to be a bit weaker than usual, I think they can slowly let go of some of their tightening measures. So we could see even more RRR cuts. I think just last month, I think PBOC has already released one wave of a RRR cut. And moving forward, I think as if the numbers were to be economic numbers will continue to be weak coming out from China, the RRR cuts could continue. A credit injection to stabilize the entire financial system could continue as well. And we see actually quite low likelihood of a hard landing for China, given the fact that, you know, the focus is on sustainable growth and towards a common prosperity theme for China in at least for the next 5 years. I think, and at the same time, with an average dividends yield of around 9 to 10%, I think the China banks right now are simply very attractive especially for, you know, your income-seeking investors looking for yield returns amidst this low interest rate environment. So the next idea would be the China tech sector. So the China tech sector has had quite a bad reputation this year so far, and that whatever is coming out from, you know, the Evergrande crisis, kind of compounded the weakness on the sector, and it has already kind of hurting its already bad reputation of the entire sector after months of regulatory crackdown. So while we acknowledge that the situation continues to be quite messy for the tech players, as the China regulators look to keep this internet giant in check, we'd like to point out that the fundamentals of the tech sector is still largely intact at the current juncture. So we like to remind investors, the long-term growth outlook for China tech sector remains highly promising. The recent sell-off, however, has actually driven valuations of this high-growth sector down significantly. Hang Seng Tech itself is down 27% on the year-to-date. It's down about 6.4% in the last 2 weeks because of the Evergrande crisis, and has actually knocked valuations now below the fair valuations. Right now, it's trading about 20 times 2023 earnings. When the usual fair PE or the average PE ratio is anywhere between 30 to 50 times coming out from the tech sector itself. But that being said, when you look into the long-term growth trajectory of the internet sector, it remains pretty robust given the fact that domestic consumption, China is moving towards a domestic consumption-driven economy. But this domestic consumption within China is actually increasingly digitalized. So your rising internet penetration, your digitalization of consumption, they have accelerated because of COVID. The supportive policy to boost next-gen tech remains very, very strong tailwinds for this high-growth sector. And amidst, of course, their pivot towards this consumption-driven economy and to reduce the reliance towards its export-driven market. And we think that sales and earnings growth will continue to be higher on average, given how closely integrated the internet sector and the domestic consumption have become over the past few years. And this trend is something that will be very hard, even for the regulators to try to decouple. So, and one of the biggest drawback when it comes to China techs as well as the internet sector has always been its very high and expensive valuations, making it quite difficult, for value-oriented investors to kind of stomach their expensive valuations. But the recent correction and recent dip due to all the negative development has actually knocked valuation back to a very cheap level, giving these investors, especially the more value-oriented one, an opportunity to get exposure to this long-term growth, the growth potential of or growth story of this sector at a more reasonable price. So once these regulatory overhangs start to clear up, I think you maybe if you take a longer-term approach, maybe it clears up in maybe a few months later or even a year. It's still quite short compared to the longer term runway or growth trajectory this sector has, and it will probably be a while. Once it starts to clear up, it'll probably be a while before valuations are this low again. So this is definitely a good time for investors who are on the fence thinking about this sector to take the bullet and to accumulate some exposure to this at the cheap. So the last but not least, investors who are just tired of this prolonged regulatory crackdown, be it within the real estate, technological sector, you can actually look towards China onshore equities, the domestic A-shares, which have kind of corrected slightly, but not as much as, of course, your other offshore and as well as your bonds. Your domestic A-shares market, which is kind of dominated by your financials, your consumer, as well as your non-internet IT, which is a lot of your green tech, your EVs, as well as your China semiconductor sectors, which are not affected by the regulations, which is in contrast to the offshore heat shares as well as ADR. We believe that domestic A-shares market is better positioned for the presidency's common prosperity theme, particularly in the short term. But if in the long term, it doesn't lose out to your offshore heat shares as well as your your ADRs. I think these are also very high growth sectors, given the rise in domestic consumption into your more critical tech. And I think interestingly, if you look in terms of the onshore equities, the A-shares, one of the biggest drawback we have for the market previously was that it was very, very heavy on your low growth old economy sectors, such as your financials, your industrials, your utilities. this is quickly changing. So you look at the China onshore equities over the last few years, there's a structural shift towards growth sectors. The weightage towards technology, this is most obvious in the weightage of the technological sector that has risen quickly within the A-shares market. The offshore, so while offshore tech exposure are more concentrated towards your household internet names like your Tencent, Alibaba, that is definitely in the crosshair of the Chinese regulator. Tech names within the China A-shares are your tech manufacturers, like your semiconductors, your 5G infrastructure, your green initiatives, so your solar panels, your electric vehicles manufacturers. So these are very critical cutting-edge technology that China wish to lead, or at least be able to build self-sufficient in the coming decade. And therefore, these sectors will actually see very supportive policy tailwinds ahead. So this is also a good time, given the fact of because of the negative press, because of the negative sentiment, for investors to start looking into these, to take advantage of the sell-off, to accumulate exposure to these high growth segments on a cheaper than usual valuations. So with that, I've kind of conclude my sharing in terms of the opportunity amidst the Evergrande debt situation.